Let's talk money.
Hello and welcome to Let's Talk Money, your weekly personal finance conversation with me, Surabhi Upadhyay. Now, this is a critical week because we are preparing for the all-important union budget, and it's the full-fledged version that we're going to get next week. So the expectations are high, as always. The common man is hoping that there will be some tax relief for him or her or for them. And then, of course, there are questions around capital gains, questions around housing. Can the government ease the burden for the great Indian middle class? Well, to help us get prepared, revise all our tax rates and to set those expectations right, I have with me on the show today Homi Mistry, partner at Deloitte India, as well as tax expert and tax consultant and CA, Suresh Surana. Gentlemen, thank you so much for being with me in the studio. It's an important time of the year once again. This year we're having it twice, right? We had a mini budget in February and now this is the full-blown one. And I guess so all hopes, all eyes looking towards the finance minister. But first, let me ask both of you, are you expecting anything big bang, so to speak? Homi?
Surabhi, thank you. We are expecting something maybe on the exemption limits. Currently, under the old regime, it's 2.5 lakh rupees, up to which you don't pay tax. And under the new tax regime, it's up to 3 lakh rupees. So there is an expectation that these exemption limits should move up, both under the old regime as well as under the new regime. So from 2.5 lakhs or 3 lakhs, it should at least go up to about 5 lakh rupees.
Oh.
So if that does happen, then correspondingly, the other slabs also then should go up. For example, under the new regime, you have a slab starting from 3 to 6 lakhs, where you pay 5% tax.
Yeah.
So if the slab does go up, the exemption limit does go up from 3 lakhs to 5 lakhs, then that first slab then maybe, like, let's say from 5 lakhs to 8 lakh rupees, whereby you'd pay a lower rate of tax.
I was just going to ask you, will that really make a difference? Because of the rebate, I mean, there's no tax up to 5 lakhs in the old regime and no tax up to, I think, 7 lakhs in the new regime.
Yes.
But you answered it, that increasing the basic rate means that everybody above also gets some relief.
They should
right?
get relief, yes.
Okay. Suresh, your key expectation on income tax per se?
No, I think this is an opportune time for making some very structural, far-reaching changes. The reason being, if you look at our tax collection last year, so financial year 23-24, personal tax collection has gone up by almost 25%, and it is at 12 lakh crores. Similarly, corporate tax also collection has gone up by almost 13%, although it is slightly below the personal tax. Also, we have the continuity of the finance minister. We also have a stable government. So I think definitely the expectation, India is right now the fastest growing large economy in the world. So really the expectations are very, very high. And I think it is an opportune time. Also, we have the fiscal legroom, so to say. Sometimes, we always have constraint, but this time there is a legroom available. So I think few structural changes definitely can be expected. See, corporate tax side, government did some major reforms. Like they brought down the tax rate to 25.17%. But personal tax, I think apart from basic exemption, which mentioned by Homi, maybe it can go to 3.5 lakhs at least under both the regimes. But the highest, if you look at the maximum marginal rate, we have under the old regular regime, a rate of 42.74%. And new regime also it is 39%. Now that is very steep. So what I feel that if we can cap it at 35.88%, and also there is a case for convergence of the two regimes now. Because 2 years back when the default regime started, the objective is that gradually more and more people will migrate to the default regime.
Right.
So even on corporate tax side, if you see now more than 90% companies are now going for the new regime.
Right.
So same way, I think personal tax also, there is too much complexity. If you look at the number of slabs, you have 7 slabs here in the old regime, you have 8 slabs in the new regime, you have different exemption limit, different maximum marginal rate. And then you cannot claim certain deductions under the new regime.
In the new regime. No,
so if you really make it simple, make it 3.5 lakh basic exemption, cap highest rate at 35.88%, and give deduction only limited, like ATC for savings, and maybe the interest on house property.
That's an interesting point. Some may say maybe a little radical. I don't know if the government can go the distance. But Omi, what do you think? I think the government's stated intent has been to get more and more people to migrate to the new regime.
Yes.
They talk about doing away with deduction, having lower, more predictable tax rates. But to what extent is it working when it comes to personal income tax? And what further tweaks would you advocate?
Yeah, Surabhi, I think now more and more people are migrating to the new regime. In fact, in this year's tax return that one is filing for financial year 23-24, it says that if the new regime is the default regime, and only if you want to switch over to the old regime, you've got to take a box.
Yeah.
So obviously the government is now more focused on the new regime. They're giving some benefits still also under the new regime. For example, they brought in standard deduction under the new regime, which is 50,000 rupees for salaried employees. And there is an expectation that this should further go up maybe from 50,000 to at least 1 lakh rupees. The other benefit that one is getting also under the new regime is that where contributions are made by the employer towards this national pension scheme, a deduction can be claimed. It's currently 14% if you're a central or a state government employee, and for private sector it is 10%.
Right.
So the government could look at rationalizing and having a uniform rate even for the private sector, so whereby contributions up to 14% to this NPS should also be exempt from tax.
Okay, well, those are some thoughts that the government could work with. Since you brought up standard deduction, I just want to bring in a viewer question here, because I think this query does relate to standard deduction. It's coming in from Arjun, who's a viewer, and he's joining us right here from Mumbai. Arjun, welcome to Let's Talk Money. Tell us, what's your question?
What are your thoughts on the need to increase standard deduction limit in the current tax regime, given the concerns about their adequacy amidst rising inflation?
Okay, Arjun, great point. We all always need more deductions. I don't know if the government will oblige or not. But Homi, you're mentioning standard deduction right now. Is there a case for it to be increased? Because somewhere there's a disconnect, right? When we say the government, the finance minister always talks about lowering and doing away with deductions, and yet there is an ask to increase standard deductions.
Yes.
So how does it tie in?
Yeah. So I would think that this request is more, it's not only from the very high income earners, salaried class, but even from the middle income earners, even they will benefit. That, and the expectation is, yes, it should go up from at least 50,000 to 1 lakh rupees.
Okay, so maybe a doubling of the limit. And right now, both the regimes give you the standard deduction, the old and the new. So let's see if there's any increase that comes in. So fair enough, we'll watch out for this increase in the basic income tax exemption threshold, increase in standard deduction. These are some of the starting points. But the big elephant in the room for many years has been capital gains tax, right? The fact that depending on the asset class, depending on the investment vehicle or the instrument of your choice, the rates, the holding periods, all of that can really vary. So, Mr. Surana, what is your view on this and what should be done?
Yeah, so I mean, you are absolutely right that at present we have a very complex capital gains regime. So you have different rates, 10%, 20%, 30% for long-term capital gain. Also, you have different periods of holding, like 12 months for listed shares and for the, in case of listed equity mutual funds, you have 24 months for the real estate and also for unlisted shares. And then you have a period of 3 years for other assets. So I think the 3-year period, today now everybody has become impatient. So 3 years is too long term. So I think 2 years is a probably reasonable period. We can do away with the 3-year, in terms of the asset class for long term. Anything held for more than 2 years.
And remind us once again, which are the asset classes where long term is defined as 3 years?
So anything other than equity or the listed, in terms of mutual funds, or anything real estate or shares of unlisted companies. Other than that, everything will go under
is 3 years.
So for example, any investment in gold, any investment in, debentures, which are, unlisted, or any other, I would say, asset, which are basically held by the, and also we have on top of it another, which is, we have section 50AA, which brings, in case your equity investment is less than 35%, then everything is subject to, it is not treated as a long-term gain at all. In case of those funds where the equity investment is less than 35%.
So it's a pretty
really it's a very complex kind of structure which is there.
No, absolutely, and that also brings in the question of mutual funds, because I think the landscape really changed. If you're in an equity mutual fund where more than 65% of holding is equity, then it's clean and simple. You get equity taxation, which remains 10% above 1 year. But anything beyond that, it's very, very convoluted, because debt funds were sort of really given a body blow when the benefit of indexation was taken away, that 36 month period. So Homi, just explain to us what is the current regime. He mentioned specified mutual fund.
Right.
So what does the law say right now, and would you expect any changes?
Yeah, so this was just brought in last year for these specified mutual funds. Basically, it's defined as a mutual fund whereby not more than 35% of the proceeds of the fund are invested in equity shares.
Okay.
So to that extent, you don't get any tax benefit, and whatever gain that you make when you dispose of these units of this specified mutual fund will be taxed at the normal rate of tax. The
Okay.
government also...
If the equity holding is less than 35%.
35% or less, yeah.
Okay.
Similar to that is the government also at the same time had brought in a change for what's called market-linked debentures. There are specified debentures which may be notified by SEBI. And what the government had said when they brought in the memorandum, they wanted to tax them at the normal rate of tax. Again, there's no indexation benefit, etc., because they felt that these MLDs, as they're called, are derivatives in nature, and derivatives are taxed at the normal rate.
Right.
So they felt that why should we give a concession
Favorable
rate
equity
of,
sort of taxation to
because
such
their returns are linked to returns on other type of securities.
Right. So, in the midst of all of this, I think the hybrid funds as a category, which is not pure equity, which is not pure debt, I mean, they really have been pushed forward by the industry as well, and even investors are looking at them. They could be multi-asset funds. So, from a mutual fund industry perspective, what sort of a capital gains regime do you think would be fair, easy to understand, and easy to sort of comply with?
Yeah. So, this equity-oriented funds, where more than 65% of the funds are invested in equity, that I think is straightforward. The rate of tax is 10%.
Yeah.
So that's, and you get this exemption also up to 1 lakh rupees of the gains.
Right.
And the government has said that specified mutual funds, they will have to pay tax at the normal rate of tax. So the other option could be to look at other funds, whereby instead of having a 1-year period, you could have maybe a 2-year period. Which are neither specified mutual funds nor equity-oriented funds. Let's say the funds invest more than 35% but less than 65%. Maybe in such cases where they're not, if the funds again are listed, then maybe you'll have a concession rate of tax, because the government says listed securities basically are securities which are held for more than 1 year.
Right.
And there you generally get a concession rate of tax. You could even index the cost,
That's another issue. What gets indexation benefit, what doesn't? So it remains fairly complicated. Okay, so we've discussed some of the, hopeful changes that maybe we can look out for when it comes to capital gains. Take a break. We'll come back on the other side and discuss housing. Can the common man expect any tax relief when it comes to housing? Back with that in just a bit.
Let's talk money.
Welcome back. You're with us on the pre-budget special edition of Let's Talk Money, where we are gearing up for the all-important day, the 23rd of July. Well, we've discussed the income tax regime. We've discussed capital gains. Let's also talk about housing. That's something that really touches the common man. So, gentlemen, we know the usual sections, right? Your Section 24, which allows you some deduction on the interest component of your home loan, and the principal gets covered in Section 80C itself. So, Mr. Surana, would you be expecting any changes? Anything that makes home ownership a little easy for the average man?
No, definitely. I think because housing sector is, apart from the fact that it also, in terms of economic growth, it also a major employment generation. And also it aligns with the Prime Minister's vision of housing for all. So one thing which is there, that in case of the affordable housing projects, now the tax exemption for the developers is not available, which was up till 31st March 2022.
For setting up affordable housing units.
So I think unless there is more investment in that sector, the people will not get housing. So I think there is a case for extending it up to 31st March 2027. The second thing is that the interest deduction, as you rightly said, under Section 24, it is in case of self-occupied property up to 2 lakh rupees only it is allowed. And under the new regime, it is not even allowed at all.
Yeah, the new regime doesn't offer you this benefit
so I think,
of home loan.
So really
interest,
speaking, for people to pay it out of after-tax income is very difficult. So there is a case for allowing the interest on housing loan under the new regime also. And that is why, again, the case for convergence, because more and more you come to that point.
Why to have the variance?
Yeah, and there's too much complexity. The third thing is in case of redevelopment projects, there is a major challenge, because according to tax authorities, amount to exchange of asset. And the new house must be completed within 3 years. Now, many cases we know that real estate development projects are taking much longer. So I think either they should make the redevelopment, as long as there is no cash compensation, you are getting the same area back, or it should be exempt, or they should allow 5 years time, because many real estate development, redevelopment projects are not getting completed in 3 years time.
And what happens? What is the tax implication if there is a time overrun?
Because even exchange of asset is it is subject to capital gains, and therefore it becomes subject to capital gains tax. And really the person doesn't have choice. He didn't get anything. And he has reinvested, but it's not in his control to get the asset within that period.
So maybe the government could.
Yeah. So I think that is another major point, which is equally important.
Fair enough. Fair enough. Anything on EVs, perquisites, anything else, Homi, that perhaps we should watch out for?
Yeah. So there are concessional perquisite valuation rules for fuel cars, like running on petrol or diesel, and then very nominal values. So that really benefits employees. Basically, it goes upon the cubic capacity of the engine of the car. So the maximum that would be there, let's say the cubic capacity exceeds 1.6 cc. The perquisite value is 2,400 rupees only.
So how does it work? I mean, and this is obviously you're taking a car through your employer.
If the employer gives you a car, either it's owned by the employer or the employer takes it on lease and then gives it in turn to you. And let's say you're using it both for official and personal purposes. So this 2,400 rupees will be added onto your normal salary income and taxed. If there's a driver given, there's another small amount of 900 rupees taxed.
Right.
Now the government has been pushing, and a lot of more people are taking electric vehicles. But what's happening is that under the tax rules, the rules have not been notified or specified for EVs.
How much of a benefit can be given for an electric vehicle?
Correct. So what should be the valuation? If I have 2,400 rupees, let's say the maximum for a fuel car, and it could be a very expensive car, what should be for EVs? So the government should come out with specific rules for that also, So that's an important ask,
Fair enough. So to sum it up, before we talk about the other aspect of the show, and that's income tax returns, let's not forget the deadline is approaching, so we're coming to that as well in just a bit. Before we move to ITR, just final thoughts on what you would expect and what perhaps could be the most important takeaways from the budget from a personal tax perspective. Homi?
Yeah, so one is increase in this exemption limit, possibly increase in the standard deduction also from 50,000 to a lakh of rupees, and also bringing on par the private sector employees along with the central government and state government employees for NPS. There also could be rationalization on the capital gains tax front.
Which is going to be the big one to watch in case we get some simplification of all the multiple rates, the holding periods, etc., etc. Suresh, in a nutshell, what would your watch points be?
Yeah, so I would definitely, once again highlight that there is a possibility of convergence
between the two
regimes,
income
because
tax
it is becoming
regimes.
Too complex. The second point is, of course, apart from basic exemption limit, which already Homi spoke about, the maximum marginal rate being capped, and 80C deduction and in terms of the interest on housing loan should be allowed under new regime also. Because just one very important point I would like to highlight, which probably has not been observed, that the saving rate in India has been coming down dramatically. So 10 years back, it used to be 34%. Now we are at 30%. If you want to maintain an economic growth rate of 7 to 8% of GDP, we need investments, whether it is new manufacturing project, whether it is housing projects. So you can't equate a normal expenditure with an investment. So we must promote the savings, culture.
And investments.
So 80C and therefore the also interest on housing loan.
Housing should be brought into the new regime as well. I think the savings rate is also coming down because we are traveling more. We want foreign holidays. We are aspiring for better houses, better cars, better watches. It is a new India, right? Maybe that also has something to do with it. But okay, now we are coming down to the final leg of this conversation. And that brings us to income tax returns. Have you filed yours or not? 31st of July is the deadline. So, gentlemen, we need a quick, ready reckoner, a quick checklist of sorts. I know I need to file mine as well. So, Homi, what should we watch out for?
Yeah, so right now the deadline is that for salaried people, and the deadline is 31st of July. So they've got to see that they ensure that the return is filed on or before 31st July. So while filing the returns, obviously they will take all the necessary documents, bank statements, and Form 16s from the employers, etc., maybe interest certificates, dividend counterparts, etc. But it's very important that prior to filing the return, every individual should be checking his or her Form 26AS, and the AIS, TIS statement, because that gives the information about the salaries, the taxes withheld, if you earned dividends, if you earned interest, if you made other kind of payments, etc. It's important that everything is captured in your tax return.
So reconcile everything.
Absolutely, you must reconcile. And it's clearly also mentioned in these AIS, TIS that in case an income which has not been mentioned in the AIS by the deductor or the payer, please ensure that if you earn the income, for example, let's say it's reflected in your bank statement and not reported there, that is also then captured in your tax return.
Got it. Any tips on this?
I think that,
like
of course, as Homi mentioned, very important point that you reconcile 26 years with AIS, because any such mismatch may result in demand later or any addition. The second important point is to select the right ITR form. So you have ITR 1, 2, 3, 4. So 1 and 2 is for people who are not having business income. And
so largely salaried people stick to ITR 1 or 2?
So ITR 1 and 2. And in ITR 1 is a simpler form. It is called ITR Sahaj also.
Sahaj, yeah.
And basically, if you have just salary income, one house property, and income from other sources, which means you don't have capital gains and you don't have business income, then that is the form.
And up to 50 lakhs of income.
Up to 50 lakh rupees of income. Yeah. And also it is not available to HUFs, non-resident, resident but not ordinarily resident people. Also, if you are director of a company or you are holding shares also, even though it may not result in income, then also you cannot file form ITR 1. So it is, you have to just make sure that you fill the right form. Otherwise, it may be treated as invalid return. The also third point is that you should put your revalidated bank account because then the refund will be quicker to get, and also you can get the EVC code for when you have to do the e-verification of your return.
Okay.
Then so one, at least your bank account which is duly validated with your PAN and your so that the refund is easier to get into that.
Okay, all right. I think those are very helpful tips to keep in mind while we're going ahead and filing our income tax returns. Gentlemen, we're out of time, but this was a very, very helpful session. Thank you so much. And we hope to have you back on once the budget exercise is over to make sense of all the new announcements that come through. For the time being, it's a wrap on this edition of Let's Talk Money. Remember, of course, we'll be right there with you, for you throughout the budget week. We'll keep getting you more analysis and, of course, the fine print, the simplified version of what it means for you. So watch out for next week's episode as well. See you again very soon.
Let's Talk Money